Greetings and welcome back. This is our second in our series for Module 1. We're going to be talking about financial statements. There are four primary financial statements we need to be concerned with and be aware of. These are the ones that are required by the SEC for disclosure in publicly traded companies. And they include the balance sheet, the income statement, statement of cash flows, and the statement of stockholders' equity, which includes retained earnings. We're going to go into a little bit more detail on each one of these, but put together, these four financial statements paint this picture or tell the story, as we talked about in the previous video, of how the company performed during a period of time. And we're going to be just differentiating between period of time and point in time, which is kind of important, as we will see when we do some analysis. The annual report includes financial statements and a bunch of other stuff. It'll include notes to the financial statements. It'll include the auditor's report. It'll include disclosures by the CEO and CFO, the chief executive officer and the chief financial officer, who get to sign off on it. We're also going to be talking about Sarbanes-Oxley, or what is known as SOX. But the core of what we're looking at in the financial statements are these four statements. So we'll look in a little more detail for each one of these, but notice the point in time is a balance sheet, the period of time is an income statement, period of time for statement of cash flow, and again, a period of time for stockholders' equity. And it will become very clear why it's important to think about in those terms. So we'll start with the balance sheet. Hence, the term balance sheet means we're in balance. And when we're in balance, we have to be in a position of being able to, I'll draw the famous T accounts that accountants like. We'll have assets on the left, liabilities and equity on the right. And you say, wait a minute, if I've got a balance here, can I write a formula to that effect? And I will say, you sure can. Assets equals liabilities plus equity. So what are assets? Well, bottom line, assets are the things we own. Those are the things that we might turn into cash, things we might sell like inventory. The cash is considered an asset. Fixed assets like equipment, a building we might own, vehicles we might own, maybe even something that's not tangible, something, an intangible asset, like a right of a patent or a copyright. Those are things we can own and we ultimately can sell. We can convert those to cash. On the liabilities front, we got things we owe, obligations to pay. We might have accounts payable that we have to pay somebody else for things we buy. We might have mortgages payable. We might have bonds payable. We have things that are due to other people. And then we have the remainder, owner's equity. Equity is the ownership interest. And that includes the profits or the losses of the operations that we have in addition to the initial investment by the owners. So that's what the owners own. And if we do a little bit of fancy mathematics, assets minus liabilities equals equity. We can rearrange that equation in good form. So let's take a look at some of the things that are showing up on a income statement. I'm sorry, on a balance sheet. So I'm going to clear that off. We'll go on to the next slide. And we will go ahead and take a look at what a balance sheet looks like. We've already looked at Walmart. If you recall, we looked at the Walmart income statement. We had revenues and expenses and a net income on there. We had SG&A, selling general administrative, which we'll see on the income statement. We had interest expense. We had a bunch of stuff. But none of those revenues don't show up here. Our expenses don't show up here. But the things we own, the cash, receivables, which will turn into cash, inventories, some prepaid expenses. We'll talk more about the accrual method of accounting versus cash method at a later date. And we got something called total current assets. So we add that all up together. And remember, this is in 6 zeros. So we get $81 billion roughly in current assets. Then we got property and equipment. We own a bunch of buildings. We own a bunch of shelving units. We own a bunch of parking lots, a bunch of real estate. And then we have these operating lease right of use assets. So we're leasing some stuff, but we have to show it as an asset. And as a matter of fact, that's a fairly recent, the past 5 years, lease rules, which we'll talk about when we get to GAAP, said, you know what? We used to be able to write an auto lease and to have lease expense. Yeah, $300 a month. We paid for our vehicle. We just put it on the income statement. Now GAAP, generally accepted accounting principle, says we have to put that on the balance sheet. And not only do we show the right of use asset, we have the operating lease obligations due within a year, and finance lease obligations and long-term lease obligations. So we're showing both sides of things that we're leasing, of monies that we owe, not the full value of the vehicle, but the value of the leased vehicle on our books. So we're showing things that we could actually sell the rights to that vehicle to somebody else, and they will take over or whatever else. We got something called goodwill, which is only created when we buy another company. We'll talk more about that down the road as well. Other long-term assets, we have total assets of $244.86 billion. If you recall, we had over 500 billion in sales. We took 244 billion in assets to make the 500 plus billion in sales. And then we get the things we owe. Here's our liabilities, and we separate those also into current and non-current or long-term. So our current, some short-term borrowings, you got to pay that back. Accounts payable, we got to pay our vendors. Accrued liabilities, those are obligations that we have recorded that we've incurred, but we maybe didn't get the bill yet. We'll talk about accruals later on. Accrued income taxes, long-term debt due within a year. You say, wait a minute, how is long-term debt showing up as a current liability? Well, we've got less than a year's worth of that debt. It's like a mortgage. You have a 15-year mortgage. 1 year that's going to show up as current. The other 14 years will be long-term. Finance lease obligations, total current liabilities, 87.379 billion. And then some long-term debt, operating lease obligations and commitments. Then we have our equity. And in our equity, we have common stock and additional paid-in capital in excess of par. Then we have something called retained earnings. That's where our profits end up, or our losses are taken out of. Other comprehensive loss, we have comprehensive income that we'll be talking about in the future. And then we have total Walmart stockholders' equity and then non-controlling interest, total equity. But notice the bottom line here, 244,660 equals 244,660. Our balance sheet is in balance. What a concept. Now let's think about that point in time concept. If I asked you, what's my inventory for the month of December? You say, that's a weird question. Do you want the inventory on December 1st? Because there's a number, I got stuff on the shelf. Do I want the inventory on December 31st? Oh, I've got stuff I sold and stuff I bought. I added to the shelves. I took away from the shelves. What number do you want, Scott? The month of December inventory makes no sense. How about my receivables? Customers owe me money. Well, do you want the December 1st receivables, or do you want the December 31 receivables, or the December 15th? That would make no sense if I said for a period of time. So it's very important to be aware that the balance sheet is a point in time, always. I know what I have on the shelf right now. I know what people owe me. I know what I owe other people. I know what my obligations are. Those are all going to show up as a point in time in the balance sheet. But let's go over the income statement. Income statement, this says for the year ending December 31. What's on here? We got revenues, sales revenue. We got expenses. We got cost of goods sold. I think on the Walmart income statement that we saw last module was cost of sales, same term. That's why accountants get the big bucks, because we confuse everybody by calling the same thing by different names. But cost of goods sold, cost of sales, cost of product sold, cost of oil for an oil company. You're going to see different names for cost of goods sold. Just be aware, if it's the stuff that cost of the stuff you buy to resell, it's cost of sales or cost of goods sold. We talked about SG&A. They separate them here: selling expenses, general administrative expenses. Then we had a loss on the sale of land. We sold some land. It was on the books for more than we sold it for, so we had a loss. And we have interest expense, which we isolate. And unless we're a bank, which has that in our mainstream, we've got interest expense outside the mainstream. Then we have income before tax. We have an income tax, and then we have our net income. There's our bottom line. That's what we call the bottom line. When we calculated our income statement for Walmart and came up with that, it was almost 5%, 4.8%. We had this would be 39,000 over 653. So we're looking at that and we're saying, maybe that's 7% net income percentage. By the way, if I asked you, is that good or bad? You can say it's good. You can say it's bad. If it was Apple, it'd be terrible. Apple's coming in at 25 or 30%. If it was Walmart, they're coming in at 4%, 5%. They'd be thrilled to get to 7%. So if you're looking at the numbers, the absolute numbers don't mean anything unless you're comparing to something. And we'll talk about ratio analysis later on. We did a vertical analysis with that net income percentage, cost of goods sold percentage, and we calculated gross profit percentage. But notice this is a period of time. What do you mean a period of time? Well, what happens if I asked you, what are my sales for December 1st? You say, well, do you want the sales on December 1st? That's one day, Scott. Do you want the sales for the month of December? Oh, that may mean something. Or the quarter ending December, or the year ending December. In this case, we have for the year ended December 31. So this is a year's worth of sales. That's got to be a period of time. If I ask what's my rent expense, if you say, well, rent expense for a day is 1/31st of my December 1st, of my December rent. But if I said, what's my rent for the month or rent for the year, that's a period of time and it has some meaning. So let's go on to the next slide. Here is an income statement for Sunoco. Okay, Southern Novelty Company. We have net sales. This is a 3-year income statement. And we have 5,590,000. Now, wait a minute. Sunoco has over 20,000 employees. I think over 22,000 employees. I think their sales are more than 5 million. And if I look at this, oh yeah, there we go. I'm in the thousands. So I need to add to this 3 zeros. So I'm at $5.6 billion in sales, $4.5 billion in cost of sales, and a gross profit of about $1 billion, about 20% on the game. I go to my bottom line. In 2019, they did really good. $262 billion. I'm sorry, 292. Let's go back down. Sorry. $292 billion. We had, didn't make quite as much. Our sales were down a little bit and our profits were down a little bit, but we still made $207 billion. And then all of a sudden we got to a net loss, net income, or in parentheses, net loss. I mean, Sunoco lost money in 2021 to the tune of $82 billion. Yeah, they lost a whole bunch of money. And where did they lose it? Well, you look down here and you say, okay, are we taking the big hits? We had pretty good profits actually over here. Our profits were really good, but then we had interest expense, okay, on par. But then we had interest expense, and then we had a real hit, early extinguishment of debt. We took a hit, okay? So we had a bunch of stuff, interest expense, and it really pulled us down. And then we had income before, netting from affiliates, and then we had a net loss, and we calculated a loss down here. So we're looking at $85 billion loss, just telling a story. It's telling us a story about Sunoco on where they're at and what's going on. But we have revenues, expenses, net income. Let's go on to the next statement. Statement of cash flow. We have something called 3 categories of cash flow. We have operating activities, investing activities, and financing activities. So when we look at that, we want to think about, well, let's take a look at our balance sheet. I'm going to go ahead and again, draw our T account for our balance sheet. Remember, we had assets, we had liabilities, we had equity. Our operations are normally associated with things like current assets. So if I go here and I say, okay, I've got current assets there, and I've got current liabilities here. So my current assets are things like my inventory, my receivables. Those are the things from operations, operating activities. I bought inventory, I sold it. People owe me money, they pay me money. Okay. Investing activities are more associated with things like fixed assets or investments in other companies, not in yourself. You're not buying your own stock, which we can do, but we've got investing activities. So we're buying vehicles, we're buying plant and equipment, we're buying machines, we're buying buildings. Those are all investing stuff. And then we have financing, which takes the form of long-term debt. We might issue bonds or equity, we sell stock. Okay. So when we look at this picture, we're going through and we're going and having our financing from long-term debt and equity. We have our operations of current liability. We have our operations of current assets, and we have investments on our non-current assets. And again, we'll see the big picture and how these fit together a little later on. But this is the overall vision of how we run a company. And the order is reversed. We start by financing a company. We attract investors. We either issue debt and we'll pay them interest, or we sell them stock and pay them no interest, but maybe pay them dividends if we declare dividends and pay some money. We then have investing activities. We invest in equipment. We buy stuff that's going to help us sell stuff. So we're going to buy machines, we're going to buy facilities, we're going to get shelving. All these fixed assets are our investing activities. And we may sell them too. Sometimes we buy stuff, sometimes we sell vehicles, we sell equipment. The best predictor of future performance is our operating activities of operations. Operating is when we buy inventory, when we sell inventory, when we have customers, attract customers, we advertise. So we have operating activities which will determine, well, if we're making money from operations, that's great. This is a continuing stuff. Financing might be plus or minus. It's sources and uses of funds. So if we're looking at sources and uses or increase and decrease, a source of funds or an increase of funds, we attract a stockholder or investor. Or we issue debt and we get money. We attract cash. That's an increase of funds. We pay back our debt. We pay back our bonds. That's a use of funds or a decrease in cash. Our investing activities, we buy stuff. We might buy machines. Again, that's a use of funds. Cash goes down. We might sell those very same machines in a few years, or we invest in another company. We're investing not in ourselves with a stock, but investing in some other entity. And then eventually we might sell that ownership interest. So that's a source of funds at that point. But then we have operations. Okay, we buy stuff, sell stuff, mainstream of our business, and that's going to go pretty consistent. Hopefully, financing is a one-shot deal. Investing is usually a one-shot deal. I mean, it's continuous, but you're not buying the same piece of equipment 350 times. Here, you might be buying the same inventory 400 times. You might be selling the same stuff, and this is our continuing going. The acronym I like to use, which makes no sense, is OIF. The three things a business does: that's operations, does investing, and does financing. Those are the OIF makes the statement of cash flows. So I'm going to go ahead and clear this out. And we're going to go on to the next slide. And you'll see we've got Nucor. Nucor has an income statement. And we've talked about this before, but if I asked you, what's my sales December 31, notice it says 12 months ending at the top. And again, we're at $7 billion. I get thousands here. So $7 billion in sale. I'm sorry, a cash flow statement. I'm back to the income statement. So we got earnings. We start with net income. And we make adjustments, non-cash items. We go down to our operations. We have receivables, inventories, payables. These are all current assets and current liabilities. Our receivables, if our receivable goes up, it means we're financing other folks. That's a use of funds. If our inventory goes up, it means we're buying more inventory. So that's a use of funds. Our inventory goes up, it's a negative number here. As opposed to our investing activities, which is similar, we're buying a piece of equipment, our cash goes down. Capital expenditures, okay? Financing activities is kind of the opposite. We get money from debt. We get money from issuing stock. If our stock increases, our debt increases, that is cash coming in the door. So if we issue debt, we're actually positive cash flow. If we're paying off the debt, okay, payments of tax withholdings on certain stock-based compensation, yada, yada, that is a use of funds, negative effect. So bottom line, we're looking through and we're analyzing. This actually goes a little bit further down. So I had to cut off the statement here. But operating, investing, and financing are the three categories we work with. You can easily tell a statement of cash flow doesn't start with net sales, doesn't start with assets. It starts with net earnings, and then it has adjustments. A income statement starts with revenues, If it starts with something besides revenues, it's not an income statement. The balance sheet, if it doesn't start with assets, it's not a balance sheet. And then we have the stockholders' equity statement. In that is retained earnings. And there's a formula for retained earnings you're going to want to know. When you start a business, you start with zero retained earnings. But retained earnings is the monies that are held in the business that can be reinvested, that are not given out in dividends. Because what does a company do? I got a question for you. Would you ever invest in a company that never pays dividends? Well, how do I get my money back if they don't pay dividends? Well, I'll tell you, most high-tech companies don't pay dividends. Do people invest in high-tech companies? All the time. Where do they make their money back? They make it back when they sell their shares of stock. The stock price goes up. So the monies they retain as earnings, they reinvest in the business. Some companies are famous for consistent dividends, paying out. A lot of companies are famous for not paying any dividends, but increasing their value for reinvesting in themselves. So new company starts with zero retained earnings. Then we get some income, hopefully positive. It could be a net loss, which is negative. Then we have our dividends that we pay out to our stockholders that we declare. And we say, hey, here's some money back. Some people say, I don't want the money back, just reinvest it. You guys are doing fine. And the stock price will go up. They'll have more profits. They'll have more equity. Your stock will become more valuable. And it's a win-win all around without paying any dividends ever. So beginning, add net income, deduct dividends, you have any retained earnings. And here's the form down here. Okay, retained earnings. Then we have net income. We have dividends paid. And we got a bottom line remaining retained earnings. Then we'll learn about common stock. We'll learn about preferred stock. We'll learn about treasury stock. We'll learn about all that down the road. But bottom line, you want to see where the profits are coming in. And by the way, this income for the year better match your income statement. Otherwise, we're all in trouble. But that's how it flows. And these numbers that show on the balance, total stockholders' equity, better show up in the balance sheet. All these statements are related. And here's a sample of General Electric's stockholders' equity and retained earnings statement. And here's 2 years worth. It's actually a 3-year statement. We're showing 2 years right now. Then it's really hard to see. We'll talk more about them. But just realize the columns are similar to what you saw here. Okay, the amounts, balance, income, dividends, ending balance. Balance, income, dividends, ending balance in each one of these accounts that show up in stockholders' equity on the balance sheet. And here's the bottom line that ends up on the balance sheet. All right. So what's the flow of financial statements? Again, income statements, stockholders' equity, and cash flows were all for a period of time. But we got a beginning balance sheet. We've got an ending balance sheet. That's going to be our flow. We start with the numbers, and then over the year, transactions happen. And by the end of the year, we're going to see what the 12/31, or if it's a calendar year business, what the balances are going to be. Now, the annual report, you remember we had to type in 10-K to access the information on Edgar in the SEC. Not 10K, but 10-K. But it's called a 10K. That, by the way, the 10Q is a quarterly and the 10K is an annual. Companies are very concerned on their quarterly statements. And all the earnings announcements you see publicized start with, well, here's our quarterly announcement, but the annual announcement has all the glorious details and background information. So what shows up? Well, you've got on a 10K or an annual report. We've got a set of financial statements, a balance sheet, 2 years worth. We've got an income statement, 3 years worth. We've got a cash flow statement, also 3 years worth, and a statement of stockholders' equity, also 3 years worth. So we're looking at audited, meaning another set of eyeballs, an outside party needing to be CPA, certified public accountants, came in there, looked at the books and said, yeah, they look reasonable. They don't guarantee anything, but it's another set of eyeballs. But what else shows up in the annual report? Well, we have the notes to the financial statements. The numbers are one thing. We'll see a balance sheet, but where does that receivables number come from? What's our inventory method? Well, what kind of debt do we have and when's it due and what kind of information do we need to know to make decisions? So those are notes to the financial statements, come right after the financials. Then we have something called MD&A, Management Discussion Analysis. So the results that are happening are described in words. It's presented in a dialogue presented by usually the CEO saying, here's what we're doing. Yeah, we lost money this year, but things are great. Our trends are down, sales are down from last year, but things are great. There's a lot of fluff in some of that MD&A stuff, but financial conditions and the results will be discussed as part of that MD&A. Also usually made on a call on a quarterly basis where the earnings call are made. They must disclose financial risk factors. Wait a minute, you mean we might be at risk of flooding and global warming? Yeah, we might be at risk of nationalization of our businesses in some countries. You bet. We might be doing business in Russia. Is that a risk? Apparently so. So those are risk factors that need to be listed, need to be discussed. Legal proceedings. Oh, you want to know if there's any lawsuits against us? Got a question for you. If there was $1 million lawsuit against one of these companies, would you want to know about it? Well, we said Walmart's sales were over $500 billion. What's a million in the scheme of things? 500 billion, a billion. That's less than 0.01%. If it's $1 million lawsuit, probably not going to worry about it. Now, if you and I had a business, 2-person ownership, $10 million business, we had $1 million lawsuit, we'd be concerned. Now, if it's a frivolous lawsuit, anybody can sue anybody these days. Would we need to disclose it? Would we need to put on the financials? That's where GAAP comes in. Things like materiality, $1 million out of 500 billion ain't much, unless that $1 million is going to turn into a class action lawsuit. Maybe it's a discrimination lawsuit that all of a sudden not 1 or 2 people are going to be on, but tens of thousands of people are going to be on. Oh, maybe we would want to know something about that lawsuit. So there are decisions to be made. It's not all cut and dry. There are rules, and we'll talk about GAAP, generally accepted accounting principles, in the next module of discussion. Internal controls disclosures are required and to be reviewed by the auditors as well. And the CEO and CFO must sign off and take legal responsibility. That happened during SOX. We'll talk about Sarbanes-Oxley shortly, but SOX, the Sarbanes-Oxley Act of 2002, basically says, we got a whole bunch of requirements here you got to worry about. We don't want anybody being defrauded. We'll talk about SOX in a few moments. We have an independent auditor's opinion letter. If you got a letter from somebody saying, well, in our opinion, the books are okay, which is what an independent auditor's opinion letter says, does that give you a boost of confidence? Well, the auditor can't guarantee there is not any fraud. They cannot guarantee there aren't any mistakes. They can't guarantee there are no errors. The point is, it is a professional looking at the book saying, well, in our opinion, that's why it's called an opinion letter, things look reasonable. The other key is you do not want a qualified opinion. The books are cool, except for going concern. We don't think they're going to be in business next year. They're going to go bankrupt. We think like Sears, they're going to close their doors. That's a qualified opinion. You don't want a qualified opinion. That's not so good. Unqualified, no qualifications is great. I know unqualified sounds pretty negative, but unqualified, no qualifications is what you want in your opinion letter from your auditor. So that concludes a review of financial statements. We're going to go in the next module. We'll talk about Sarbanes-Oxley. We'll talk about GAAP, generally accepted accounting principles. We'll talk about IFRS, International Financial Reporting Standards. But for right now, just wanted to give you an overview and some insight into the 4 basic financial statements, which we will be diving deeper and deeper in this semester. As a matter of fact, we'll go down the balance sheet. We'll analyze receivables. We'll analyze inventory. We'll analyze fixed assets. And we'll do a deeper dive in each one of those areas. We'll look at revenues and expenses. We'll look at generating sales and the impact of activities on our bottom line. Thank you for your participation. Hope you found value and some entertainment in this session. Look forward to our next session together, and we will talk soon.